afternoon, everyone. I am so sorry. Apologies for the delay on starting today. I had some major technical difficulties, but we're going to go ahead and get started. And actually, one of our panelists is having some difficulties and is logging in right now. So hopefully she'll be joining us soon. But I'll go ahead and go through some of the housekeeping, like our CPE stuff, while we wait for her to join us. If you haven't joined one of our virtual coffee talks before, you can earn CPE credit by attending this webinar. You just need to make sure that you respond to at least 3 of our polling questions. And then you will receive an email within about 3 to 5, at the most 5 business days, with instructions on how to access that CPE certificate. We also have a course evaluation that will pop up at the end of the webinar, and we ask that you please take the time and fill that out and give us some feedback on how we can do better. Hopefully next time we'll have better, we won't have so many issues, but we've got a great program here together, and Kevin is going to go ahead and get us kicked off, and I will hand it over to you.
Thanks, Sarah, and thanks everyone for taking the time to join us today. We have a, I guess, late-breaking type panel in which we're planning to talk about hot tax topics. And today I'm really excited. Kevin DeYoung from Wolters Kluwer is on as always, and it's always great to hear his presentations as far as how Answer Connect can help us do our research. In addition to that, I'm joined today by Adam Benson, who's a fellow MD at Alvarez & Marsal. He's the head of GTT, and so he sees a lot of transaction work and sees sort of the trends, and so it'll be interesting to hear his views. In addition, Angela Russo, who's a partner at Winston Strawn, is going to be joining us, and she works on large, small size transactions, you name it, and it's really interesting to hear both from a legal as well as a consulting perspective how we're seeing potential tax reform proposals impacting the market, as well as the trends and challenges that are occurring in the marketplace. And so you can see we're going to set out talking about tax reform and then look at sort of non-tax reform trends and challenges. And let's sort of level set, right? I mean, everyone has heard me that's been on the virtual coffee talk series and has heard, okay, well, tax reform, it's coming, it may be coming, where are we now? Well, on Friday, November 19th, the House finally passed the Build Back Better Act. It's a reconciliation bill, and that comes with several key facets. And so first we say, yes, the House actually passed the bill, that's great. But now it moves to the Senate. And because it's a reconciliation bill, the first key stop in the Senate is actually at the Senate parliamentarian. And when you look at the Senate parliamentarian, they say, okay, is this or isn't this allowed to be included in a reconciliation bill? If the parliamentarian says no, then the Democrats can choose to try to override the parliamentarian's ruling. However, that's very, very rare. And so generally, the parliamentarian's rule is final, and so that provision may be strict from the bill. Then you say, okay, well, after the bill is cleaned up or provisions are removed, the Democrats are going to look and see what can we actually pass. And that's where we start seeing these 4 names that are on the slide, which is Senator Sinema and Manchin. We've heard their names a lot. We'll be talking some of their views. Senator Sinema saying, I don't want to increase any taxes. Senator Manchin, being from West Virginia, saying, okay, we want to not necessarily push natural gas and supporting all of the EV efforts. And you have Senate Finance Committee Chairman Wyden, as well as the Senate Budget Committee Chairman Sanders, saying, okay, I want to add all of these proposals that are really Democrat sweet spots. Now, with that said, let's talk about timing. We're now sitting here at the end of November. We're looking to say, okay, I have year end, it's in the mist, it's really coming fast, and it says here the anticipated timing is year end. And that's what the Democrats have been saying. It's important to note that Senator Manchin has said, I have no need to get it done by the end of the year. But a lot of Democrats have said, we really need this done by the end of the year. So it's going to be a mad dash to the finish, especially when you consider everything else that Congress has to deal with. We're talking about the defense authorization, the government funding that expires December 3rd, the debt limit that supposedly is going to be reached December 15th. And on top of that, the Democrats are saying that they're trying to get some form of supply chain legislation through the end of this year. So you can imagine the amount of legislation that has to be going on in a very limited number of days. So with that, let's just sort of talk about the tax reform proposals. And we thought it would be helpful if we broke it out between those that are impacting sellers and those that are impacting buyers. And so when we look at the sellers, we say, okay, tax rate changes. That's always really important. Ordinary income, capital gain rates, that was like the first thing that came out when Democrats were talking and saying, hey, we're going to increase rates. And as I mentioned, Senator Sinema said, I'm not in favor of that. And because, as we've talked about, the Democrats only have 50 members in the Senate, and the Republicans have said, we will not give you one vote to pass, they need to get everyone in line. And as a result, the ordinary income and capital gains tax rate increases have been thrown out the wayside. And I'd say, okay, so rates are the same, but not so fast. Within this bill, there's something that's referred to as the surcharge. Now, how this is different, I'm really not sure. But it is a surcharge on modified adjusted gross income. And the way that it applies is it's a 5% surcharge on modified adjusted gross income in excess of $10 million for individuals and $200,000 for estates and trusts. And so if you have your AGI, your modified AGI, and it exceeds that amount, the excess is subject to the surcharge. Now, on top of that, if you exceed another threshold, which is $25 million for individuals and $500,000 for estates and trusts, then that excess amount is subject to an additional 3% or a total of an 8% surcharge on the modified adjusted gross income. So from the excess of 10 million to 25 million, subject to a 5% surcharge. The excess of 25 million will be subject to an 8% surcharge. The other thing just to note is net investment income tax. And this is a provision that many people were aware of. It's been around for a while, and it's the 3.8% tax that people sort of view it as, oh, okay, well, it's my passive income. It's the income that I get on tax, on dividends or interest or something of that nature. But taxpayers have been taking the view that it's not subject to certain types of income, including the distributive share of certain income from partnerships as well as S corporations. This proposal revises that and says, okay, well, if you're a taxpayer that has a modified AGI in excess of 400,000, and again, you're going to be hearing this 400,000 number a lot today because that's the threshold Democrats have generally used to identify what they view as high income earners. So they say, okay, well, if you're a high income earner, so your modified adjusted gross income is in excess of $400,000, then the 3.8% NIIT will apply to income derived, in essence, in the ordinary course of a trade or business. So if I own a partnership interest and I get my distributive share of the partnership's operating income, that's now going to be subject to the 3.8% NIIT. Similar to S corporations, the distributive share from the S corporation to the shareholders will be subject to the 3.8% tax, so long as it's not already subject to, in essence, FICA or SICA. So if you get it as a guaranteed payment, and so therefore it's subject to the tax, you don't have to worry about subjecting it to NIIT as well. And so I guess I'll start with Angela to see, there's all these tax rate changes that are on play. What are you seeing in the market? How is this impacting deal activity and what you're seeing?
So, earlier in the year, we saw a lot of sort of deal activity sort of in reaction to anticipated rate changes. Though interestingly, these particular sort of changes aren't really sort of driving much deal activity. A lot of that's because pricing is really aggressive right now. It's really a seller's market. And so there's just a lot of deal activity right now in general. So taxes are only making a marginal difference. There's, I'd call it sort of one exception. The change that you just outlined, I'll call it the surtax, the surcharge and sort of the changes to the net investment income tax are motivating certain sellers, especially in the mid-market, to try to get deals done by year end. But those are really deals that are already in play because these changes just came out recently. So it's really impacting the timing of deals. So I guess, Adam, you and I were talking about earlier kind of some, more specific changes you were seeing. For example, you'd seen some sellers ask for gross ups for the net investment income tax.
Yeah, that's right. And I think that anytime we see proposed changes and uncertainty in the market, a certain group of taxpayers that are very tax sensitive will try to build in contractual provisions to protect themselves in case of a change in rates. And as you noted, there was clearly a lot of things driving deal activity to record levels this year, not just taxes, but I think the potential for tax rate changes didn't hurt the market in that it brought more sellers to the market. And as more sellers came, more buyers came in. I think the market kind of fed on itself, right? But now, earlier in the year, there was a lot of concern around significant changes in ordinary and capital gains rate, as Kevin was mentioning. So we had people talking about trying to get deals done by year end. The capital gains rate had been proposed to be retroactive. So people saying if you don't get a deal done by X date, that maybe that would be a condition of closing. There could be some kind of gross up. Now, I think, that stuff started to fall off after Senator Sinema's comments. Now we're getting to the end of the year and these changes could become effective. So changes in the NIIT, which might impact an individual's personal tax situation, depending on the timeline of a closing, has started to become a conversation, as well as potentially if they're going to be subject to a surcharge, their after-tax proceeds on a sale are going to be different, and therefore they could be looking for incremental value or some kind of gross up, or you at least use that as a trade in the transaction to get something else. Those conversations are now starting in earnest, but as you can imagine, it is, and I'm sure you see the same, it's very challenging to negotiate those things because we don't know if this is actually going to happen, right? So it's almost like you're building in theoretical belts and suspenders for sellers who are trying to negotiate those types of things in a transaction where there's a lot of uncertainty, right?
Yeah, a lot of the changes I'm seeing are they're trying to accelerate deals that are already happening, right? It's sort of adding additional certainty to transactions already happening to try to, I'll call it, box their risk even a little bit more so they know what the outcome will be, at least when it comes to potential changes to the surcharge and the net investment income tax. I know there's a couple other changes that are a little bit different than the current law now that Kevin's going to talk about, where we're seeing a couple of different things.
Yeah, and just a note on the surcharge, it's really interesting because, Adam mentioned the NIIT and the gross ups. I've also heard that some in the market are trying to say because it's applicable or proposed to apply for taxable years beginning after 2021, people are saying, okay, well, if you're dragging your feet as buyer and so it closes in 2022, now I'm going to be subject to the surcharge. I want to gross up on that as well. And so there's a lot of interesting plays that are coming in as we're getting closer and closer to the end of the year and the proposed effective date, where you're like, okay, well, what happens on deals that go through regulatory approval? And so you're going to have to deal with, okay, well, whose fault is it that the deal delayed? And as well as, okay, well, we're really close to the finish line, we're going to close it. How do you want to structure that compensation? Do you want it all in 2021 so you're subject to tax? Do you want to delay it over multiple years? So there's a lot of interesting things that are going on. But as Angela was saying, let's turn our attention to some more proposals that are impacting sellers. The first one isn't so much impacting sellers per se, except for potentially encouraging carve-outs. And what that is it's the book alternative minimum tax. And you would say, okay, woohoo, I knew that corporations had a AMT, and I know that corporations are currently not subject to AMT. And guess what? What is old and new again? And again, this is now a alternative minimum tax. How this is not a tax rate increase that Senator Sinema is not okay with. Again, she was opposed to corporate rate tax increases, but it appears that this rate increase may be okay. It applies to corporations that, after applying aggregation rules, have an average annual adjusted financial statement income. And I'm going to say that again, average annual financial statement income. So this is derived based off of financial statements. This is one of many of the provisions that's putting great pressure on how are things treated for book purposes, not tax purposes, and how that book treatment is going to dictate how things are treated for tax purposes. And what I mean by that is you're going to now be subject to tax if you have, over a 3-year period, this average financial statement income greater than $1 billion. And you say, wow, $1 billion, that's a lot of money. And the Democrats are saying, okay, we're really designing this to get the top companies in the United States to be subject to this, as opposed to saying that they're able to calculate a low taxable income while having a high book income. The difficulty with that is in determining whether or not you satisfy this 3-year period average calculation, it applies a broad aggregation rule that is also proposed to be broadened as part of this proposal, such that private equity companies may have to aggregate their portfolio companies in places where they're currently are not. And so when you start thinking about it and you say, okay, well, all of these private portfolio companies under a fund may need to be aggregated, it might actually rise to the level of this $1 billion threshold. Now, if a corporation is foreign parented, then after taking into account the aggregation, they have to satisfy the 1 billion, but after taking into account a limited aggregation, they have to have a greater than $100 million income. So there is a carve back or a recognition that for foreign parented companies, they are taking into account some of the foreign earnings, and then they're taking away from some of the foreign earnings, but it does have this added layer of complexity, and that's going to be some of the story that we're going to be talking about on this slide. There is just complexity. For example, okay, if you have book losses, what happens? Well, the provision provides for a book NOL. Okay, I know what an NOL is. What is a book NOL? Well, we're going to now need to have all these new rules. For example, do I need to do a 382 study for book NOLs? Is that an attribute that's now subject to it? What about in consolidated groups? Does this mean that it's going to have a Surly principle to a book NOL? Carry forwards, is it subject to the 80% limit? It's sort of not treated, but it is treated like an NOL. And the other thing to consider, and especially relevant for this topic, is what happens when people join and leave the aggregated group? And so when you join the group, what happens to that history? Presumably, you don't have to include that history in looking back. But when you sell someone, that history also doesn't leave, because it presumably is based off of what was your financial statements for that given period. And in that given period, that entity was there. And so as a result of that, if you sell a very profitable division or business that gets aggregated, even after the sale, that profitable business can taint the other businesses on a going forward basis, because it looks at what is the average income over a 3-year period. On top of that, small businesses and S-corp shareholders are always really looking at, okay, do I qualify for the qualified small business stock? And this is a very popular provision that we deal with all the time. And the proposal looks to restrict the availability of this. So currently you're able to eliminate 100% of the gain, subject to a limitation. And so for taxpayers with an AGI, you guessed it, of at least $400,000, the exclusion is now limited to 50%. And so while there is an exclusion, it's now reduced. And so as a result of that, taxpayers are saying, wait a minute, I was planning on now investing in this company, and I was going to be able to pull out all of my gains tax-free. Now all of a sudden it's subject to tax because of this change. We did get a question from the audience saying, are any of these proposals retroactive? And it's great, because this is actually one of them. this proposal is actually retroactive or proposed to be retroactive to September 13th, 2021. And so any deals that were not signed up or announced or, binding commitment as of that date, even if they're done afterwards during this taxable year, the 1202 change will apply to them. They won't be subject to the surcharge. The NIIT is not retroactive. But this is something just to highlight, and just to skip down, and I'll skip back. The SALT deduction limitation is also retroactive. It applies in essence for this whole taxable year. And so as opposed to being a forward-looking, it applies for the current year. Section 461L is an interesting provision, and many people don't know it by number, but it's the excess business loss limitation provision. And what it does is for non-corporate taxpayers, it limits the ability of deducting your excess business losses, which is your net business losses. So you can't use your business losses to offset your non-business income. The change that they made, and this is a pretty significant one, is they made the limitation permanent as opposed to having it expire, but it treats the excess as an expense in the subsequent year as opposed to a net operating loss. And let me flesh out a little bit why that's significant. So in the next year under current law, you say, okay, I have a net operating loss, and so I'm able to utilize the losses in a subsequent year. It's more of a timing provision. Under the current proposal, it says not so fast. We're going to just treat that loss as excess deductions. And so in the next taxable year, I say, okay, that now factors into whether or not I have an excess business loss in the next taxable year. Okay, well, let me think about how that becomes relevant. So if I own a trader business that's been generating losses and I sell all of my business to Adam, well, I no longer have a trader business that's generating any income. And so my ability to utilize my excess business losses are generally suspended because I don't have any income to offset it, as opposed to in an NOL where I would be able to utilize it. Now there's ability to sort of very slowly utilize it, but it's really a de minimis amount. And so this is a provision that really can impact people that have businesses that are generating losses. The international tax proposals, we honestly can be spending the next 8 hours talking about them, and that will just sort of be like the skim surface of the complexity. And so let me just sort of highlight to you just how much fun we can have in complexity. As a general rule in the current law, I need to be a U.S. shareholder of a CFC in order on the last day of the CFC's taxable year in order to have an inclusion. So if the CFC has a calendar taxable year and I sell my CFC to Angela, I know in the middle of the year, I know that I do not have a subpart F or tested income guilty inclusion during the year with respect to that CFC. That now all gets flipped on its head under the current proposal. And what it does is it says, okay, well, we're going to have two sets of rules. One rule for if you owned it at the end of the year, and one rule if you owned it at any time during the year, but not at the end of the year. And so as a result of that, in my fact pattern where I sold my CFC to Angela, I may have a subpart F or tested income allocation such that I have an inclusion where currently I wouldn't. And so you're going to have all these questions as far as how do I determine what that amount is? And that actually is going to be based in large part on what happens also after I sell. So it's not just limited to the activity at the time that I sold it, it's the whole year's allocation. And you say, okay, well, it's an allocation. They're trying to make sure that I pay my fair share. However, when you go through the provision, it's possible that for sellers, a pre-sale distribution can put them in a worse place than if they actually just received the total proceeds from the buyer. So if I get a distribution from the CFC and then a reduced purchase price from the buyer, I can be in a worse place than if the buyer just paid me in full. Additionally, it's possible that the aggregate inclusions of all the shareholders may be greater than the total subpart F or tested income that's generated by the CFC. So normally when you think of allocations, it's like, okay, there's 3 of us on, Adam, Angela, and Kevin, 1 for each of us, we're done. well, it's possible that we can end up, instead of saying 3, it's really 5 because of the mechanics. On top of that, we're still eagerly waiting for the regulations governing previously taxed earnings and profits and how did the basis rules work. And so really there's a great level of uncertainty associated with that. On top of that, I've talked about GILTI and some of the GILTI changes. You're going to have to look at possibly calculating this on a country by country basis. And so again, similar to the 461L changes, if I'm in a jurisdiction and I'm generating losses, I can't use those losses to offset the income of another jurisdiction. So now if I'm setting up a new biz venture, I can say, do I want to set this up in the existing jurisdiction that I'm in, or do I want to actually go to a new jurisdiction? I'm incentivized to say I want to start it in the existing jurisdiction because any losses can then shelter the income versus being suspended if I use it in another jurisdiction. And on top of that, if I say I want to go in country X, it's a new country, I'm all gung-ho and I generate losses and then I hold in the tower, those losses are suspended. It's not a matter of saying I get to now use them. So it becomes a really interesting place. It's one of the few provisions, or one of the provisions that really can say tax can drive some of the business decisions that are in play. Recognizing the time when we started late, I want to highlight BEAT is something that taxpayers have been mindful of. If the proposal sort of changes who may be subject to the BEAT. So when you're looking at buying a company, you no longer can say, oh, okay, you haven't been subject to the BEAT before. When I buy you, you won't be subject to the BEAT. This provision changes the calculus starting in 2022. And so what happens is you say, okay, I now need to redetermine, am I subject to BEAT? Because what constitutes a base erosion payment is now changed. In fact, the focus is now sort of, because they're now excluding income that's subject to US tax, the focus of the BEAT has sort of shifted from US entities with foreign subs to foreign parents with US subs. Because if I make a US sub if a US parent makes a payment to a CFC, presumably that CFC's income is going to be subject to US tax, so it will be exempt. So it's really a dynamic shift in how people are thinking about the BEAT. And obviously, with the complexities of country by country, you have to start thinking about, well, what does that mean for foreign tax credits? And all I have to say is I started hearing about these proposals and I immediately ran out to my local store and I bought baskets. And why is that? Because I'm going to have hundreds of baskets. I'm going to have baskets in every jurisdiction, in all the different categories, especially when we're waiting for all the PTEP rules and saying, okay, we're going to have these baskets, here's the allocations, here's the rules. It's just going to be very, very complex. And as a result of that, I presume, what I'm going to hear is, Adam's going to tell me, okay, this complexity is going to be voluminous and really drive the market to sort of say, people are going to have to start thinking about it now. People are going to start having to think about planning now. And so right before I get to it, I know SALT is really hot. Adam, just to sort of close the loop on the SALT, I teased it out saying, it's retroactive to 2020, for taxable years starting after 2020, so really this year. The current proposal is to increase the cap to $80,000. However, there's currently a proposal that's being kicked around the Senate, just to give you an idea, which again, $400,000 magic number, right? There's a proposal that says, instead of saying everyone gets to deduct taxes up to $80,000, we say, okay, the existing $10,000 cap doesn't apply to taxpayers with income below $400,000. Above $400,000 is subject to the cap. So this is a place that we're expecting great movement on in the Senate. Several provisions seem to be somewhat baked, but this is one that, until the dust settles, we really won't know what the final provision is. So I know I ran through it really fast, but I also, want to hear the great insights Adam and Angela say. So Adam, what do you see on this slide? How is this impacting the market?
That's a lot to start.
Let's start with AMT. Start where you start there. Let's start with that.
Yeah, we'll start with AMT. So there's obviously a ton of nuanced questions in that, and a lot will depend on how the final, statute and regs end up, right? But I think on its face, the big question and the things that we're thinking about and talking about with clients is there's real questions on just business valuation, right? What does this mean? It's a big number, right? Tax doesn't necessarily always drive business valuation in a meaningful way, but it can in certain situations. And as many of you know, a lot of players in the market will look at business valuation from an EBITDA perspective, EBITDA multiple perspective, right? And tax is not part of an EBITDA multiple. But when you look at an LBO model or a financial model run by a buyer, tax becomes an important, or cash flow becomes an important part of overall valuation. We're thinking about debt service or IRR and other things, right? So even though tax is not an EBITDA, it does impact valuation, and having a relatively significant increase in tax for a business that is subject to this could have a meaningful impact on valuations. And I think that if you know it's there, right? If they just increase the statutory rates, it's one thing, and that gets built into the market, right? If you don't know it's there, or you're changing, maybe you're buying a business that is under the gross receipts threshold into a structure where it would be subject to the gross receipts threshold, or it's less clear, you need to model that in right up front. And you're thinking about both business valuation, but then also a lot of the things we're asked about is how do you value tax attributes in a system like that?
Mm-hmm.
Do you get to carry over your book NOLs and value those? Are they subject to a 382 limitation, AMT credits, right? And then whether the business is or is not going to be subject to that, say it's being bought by a private equity fund that itself would be part of a group, starts to become very questionable about how do you really value the tax side of this business, how does it impact the overall organization? Sorry, Angela.
Well, similar to the ERC questions that folks just went through, right? Which is, hey, do you have to aggregate these groups for ERC purposes? It's going to be the same type of analysis, right? For this new book alternative minimum tax, right? Is where do these groups begin and end? For a big public company, the question's, pretty straightforward. But once you get into, these big private equity structures, these big, sort of, I'll call them alternative structures, the questions are more complex, and it's going to get, the questions might not make the answers might not make intuitive sense depending on where the guidance comes out, where the final lands.
And I think when you, sorry, go ahead.
I said something to watch out for, so it wasn't actually a very substantive last thought.
No, that's all right. I was just going to say, the determination, like you said, and we haven't gotten to the slide about who you have to aggregate into a group in a financial sponsor context, right? And that can be broad. That can be family offices. It can be traditional private equity funds. It can be closely held private equity funds. Hedge funds or venture capital funds. There's a lot of people playing in the space, taking controlling interest in businesses these days. Yep. It's not always that clear where the group begins and ends, and you have two buyers potentially, one where you would have to aggregate and one where you would not, right? Where you would not, or at least they take the position you would not. I mean, theoretically, they have a different view on valuation than somebody else. And I see the polling question come up. So Kevin, you want to read that real quick?
Yeah, just to jump in, remember you have to answer the polling question in order to get CPE credit. Do you believe Congress will pass some form of the BBBA this year, yes or no? And with that, I'll turn it back, Adam, or I guess Angela, if you want to discuss the 1202, the qualified small business stock.
1202. Sure, 1202. Oh, sorry. I can't see.
I can't see anybody, so I don't know. I just see the quick poll here, but just the one other point is just this, not a tax point, but I think once you start basing tax consequences on financial reporting answers, it starts to raise questions around GAAP positions. And as any of you know that are accountants that have spent time in that world, it's not always that cut and dry. Often perspectives are averse in that you're trying to report generally higher GAAP income and lower taxable income. But I mean, that could start to change, and position could change on GAAP reporting if that has an impact on whether people are subject to these rules or not.
Well, and the GAAP standards are sometimes different, right? There's materiality standards in GAAP, which are not the case for tax positions. And it puts a lot of pressure on different reporting standards and which have developed for very good reasons, frankly. So it gets very complex very fast.
Yeah.
But back to one of my favorite code sections, 1202, which is a bit sad that not only is it being pared back in the latest legislation, but also it has been pared back with retroactive effect. So 1202, as probably many of you on the call know, is right now a complete exclusion, but because it is being pared back halfway under the current bill and retroactive till mid-September, it could have a significant effect on the space going forward. And what I mean by that is that right now for startups in certain industries, there's a big push to have them set up as corporations, but going forward, we may see more flow-throughs. It's really unclear what will happen. But right now, we're not really seeing much change because there is still some benefit. One thing to note versus the prior version of the partial benefit is that in the prior law, it was not only was it a partial exclusion, but it was also an add back for AMT purposes, which we're not seeing right now. So it's still a benefit. It's still, 50% exclusion for capital gains, even if you're above the magic $400,000 number. So I'm right now not seeing much change, but I do know that folks are unhappy about it, and at least they're considering changing their approach. They're talking about, maybe we'll have to look at whether or not, if we have, thinking about changing the structure of some of these entities, or do we need to make sure we structure it as stay in 1202, et cetera. But I'm not actually seeing any changes yet. I don't know, Adam, if you're seeing any changes.
No, similar feedback. People aren't necessarily happy about it, but I haven't seen it actually change or kill a deal, given that it's there, because it still is a meaningful benefit.
Yeah, it's sort of dialed back, but not 100%. And then I haven't seen folks really focus on the excess business loss provisions yet. I think they're kind of under the radar, but I think they're going to be substantial, especially because, there's kind of a market developed on what happens with transaction tax benefits. And it's really going to impact sort of what that benefit is going forward. I don't know, have you started talking to your clients about it yet?
It's mostly come up in the context of, again, it's more for the lower middle market. We're representing sellers in transactions and very sensitive to after-tax proceeds. And I think this could have an impact, obviously, on what after-tax proceeds are from a transaction and trying to maximize the deductibility of losses before you exit a trade or business, and therefore basically can no longer use those losses, which before wasn't as much of a question. And I think also in the context of, there's a lot of questions when buying assets or doing deals where you can change the legal entity form from a buyer perspective. Do you want those entities in flow through or corporate? And every time all these rules change, the relative, perspective on that changes a little bit, right? Is it better to be in a corp now that the rates are lower? Yep. If you're going to be running losses in a business, is it better to keep those losses now in a corporate entity rather than have them being disallowed up at the shareholder level? And I think that this, that will tweak the balance a little bit for certain people that maybe it's going to be less efficient to have losses flowing up to individuals, and therefore maybe you put those in corporate form, and that's part of the conversation that people are starting to have now.
Especially with corporate rates staying at 21% and the surcharge plus the NII effectively increasing, personal income tax rates for high earners. The international provisions, I just had one comment. I know you have a lot to say on this from our previous discussions, but it's really interesting. When I was sort of negotiating deals, if I was a seller, right, I wanted to, it was really the buyer's issue. The buyer just didn't want to get tagged with the seller's, share of the, I'll call it CFC income. They're guilty, etc. Whereas now on the seller side, they're not going to want to get sort of double hit with this sort of income going forward, assuming these changes go through. So all this complexity is going to be really important when you're on the sell side going forward, because they're going to have to understand it to make sure that economically they're not hit twice. Whereas it used to be that it was really a buyer problem to make sure that they weren't hit with whatever the sell side was, but you could really elegantly just deal with that in the agreement, figure out what the hit was and call it a day. post-closing. That's just not going to be the case going forward.
Yeah, I think it's the 2 points you hit there. One is, what is the hit? Because we're not going to know until the end of the year, and you're negotiating a contract in the middle of the year. You don't know what it's going to be. You can try to contractually kind of, frame that, right, with language around how it will work regardless of the number, but materiality generally matters on how much people care, right? And then who gets hit with it, especially if you have people coming and leaving throughout the year. Both going to be challenging questions, as well as what Kevin raised, that you could end up with just a wrong tax answer, that there's more income than there should be. But yeah, I very much look forward to being in the situation where we're, asked by our client to figure out, do I need to care about this? And what's the hit, and should we put it in debt, or where should it go? And the first point's going to be, well, we have to model it and quantify it, and it's January, so tell them what the business is going to do for the rest of the year. So I think that would be a very challenging change, and I think the market has kind of developed a view, like you said, around dealing with post-close inclusions through debt or negotiating as part of the agreement. This would just flip that stuff on its head. And then just real quick, so I know we're short on time, on the broader international provisions, I think complexity on complexity, right? And there's going to be a need to increase, there's going to be an increase in cost for compliance if we move forward, right? Which obviously can impact valuations of certain businesses that have very complex structures. But then also actually modeling out what the effective tax rate is going to be for a business when you're running, a tax model as part of a financial model, as part of a deal. It gets much harder, right? Because you can't look at it in aggregate. You can't take kind of higher level positions on net tested income or loss. You're going to have to do it country by country. And that obviously gets more challenging, and it really builds into questions around global transfer pricing, how the business is going to operate. And the transfer pricing questions become very meaningful because you need the earnings to end up from a tax perspective where you need them to end up to comply with local transfer pricing, but then also potentially to optimize, the guilty positions for the business. So there's a lot there. Just figuring out how to do it would be very challenging for a lot of companies from a books and record perspective. But then, thinking about the question that comes through, say, what ETR should I put into my model for the deal for a big 40 country, transaction with a lot of income and loss making entities? I mean, it's going to get very challenging, and I think it could really impact valuations of businesses going forward.
Yeah, and just to chime in, I realize that we started late. We're going to run a few minutes late, but just so everyone has the opportunity for a polling question, do you think the M&A deal activity increase, continue at its current pace, or decrease? And while you're answering that, I want to just quickly run through some of the proposals that are impacting the buyers. We shouldn't forget about them. There's changes to 163J limitation for partnerships. And what it does is it pushes it up to the partners. And so that's definitely a welcome change. You don't have to worry about all of the different allocation rules that were in play in the current regs. There's a new additional limitation on interest expense, which is actually, I want to flag for people, which is much broader than the previous proposals. It can apply to both domestic and foreign parented groups. The focus, again, is on book interest expense. So this is another provision like the book AMT that is going to focus on book interest expense. The way that it looks is it, in essence, presumes that each dollar of EBITDA requires the same amount of leverage. And so as a result of that, it actually may encourage unnecessary borrowing in the foreign jurisdictions, so that the U.S. entities that require borrowing to actually be able to sustain its deductions. And so this is a new twist on top of the 163J complexities that multinational groups are going to have to deal with. As Adam highlighted, there's a change in certain common control rules. This is applicable for, can you use the cash method, 163J exclusions, R&D credits, and the calculations, the methodologies. The book AMT, we had recently put out a client alert for that, and if you need help finding it, feel free to reach out to me. I'm happy to send you the link to it. It's really something that has sort of slept under the radar, but it can have broad application in the private equity space. And then we talk about the international tax provisions, and you're like, okay, Kevin, you already spoke so much about them, there can't be any more. And I feel like I'm on a show saying, but wait, there's more. And guess what? There is. One of the things just to note is they're proposing to narrow the portfolio interest exemption. And so you're going to have to now say interest that's received by a person that owns 10% of the value is no longer eligible for that. And so this is something that's going to obviously play through. Just before I see to hear Adam and Angela's comments, other tax proposals, because we are running short, I wanted to make note of is there's changes to divisive reorganizations, particularly it's going to become more complicated and there's going to be greater tax analysis necessary to deal with the distribution of property or controlled securities to distributing creditors. Worthlessness and granite trust planning is something that is going to have to be visited. And so there's a lot of great questions that are going to be raised as part of this proposal. Research and experimental costs. This is something that's really big. A lot of people have been paying attention to it because in 2022, it's set to go and say you're not allowed to immediately deduct your research and experimentation costs, but instead you're going to have to capitalize it and amortize those costs. And so this is a proposal to walk that back and say, no, you actually get to deduct it. So this is a big taxpayer favorable welcome change. Exec comp, just to note, they're applying the aggregation rules. But again, what they didn't do is sort of a surprise is they didn't accelerate the application of the changes that are coming down the road to 162M that deals with the 5 highest compensated employees. And obviously cryptocurrency, it's a hot topic. If we talked about everything that's going on in cryptocurrency, that would be another panel. It may not be a full 8 hours like the international one, but just note there are cryptocurrency reporting provisions that are in here and changes that are associated with cryptocurrency. And they're looking at possibly making further changes to the cryptocurrency provisions in the Senate. So again, this is an area where we're potentially expecting some movement. So with that, I guess, let me turn to Adam, if you have any quick thoughts before we jump to a few M&A trends and challenges.
I would just say that the R&D cost would be a welcome change, and for certain businesses that has a very meaningful impact on the tax profile, and buyers have started modeling that in, and it can very significantly change the perspective view of cash tax costs versus this historical view. So I think that would be a very, very welcome change. In the 163J, I mean, there's a lot of implications of that around debt structure and how you would deal with that. But Angie, I mean, USC, when you're trying to place debt around a global organization, it's hard enough already, and it's very hard to push debt down into local countries. And this would motivate even more of that, right?
Yeah, I wonder how it's going to play out, because a lot of the concerns actually with pushing debt down in non-U.S. jurisdictions, with a couple of exceptions, are actually not tax. They're non-tax. It's actually getting the security you need and getting it to work from a, I'll call it debt credit law perspective. So this might actually have a lot of inadvertent consequences that will be interesting to see play out. And we might all have our corporate finance colleagues a little bit frustrated with this because they're really frustrated with Congress going forward because of these changes in the rules. Because what would be best from a tax perspective may not be actually possible in practice. So we'll see.
Yep. And really quickly, we're going to open up the next polling question. And while we're discussing some trends, it's really easy. If you'd like to schedule a call with either A&M or Winston & Strawn to either discuss potential transactions or tax reform in general, feel free to check whatever box is appropriate. And with the few minutes that we have left, just to sort of highlight some of the trends, obviously structuring of consideration is something that's big. We've highlighted on the slides, insurance is a big talking point. Whether or not it be indemnities, reps and warranty insurance, broadening of insurance. I guess, Adam, Angela, what are you seeing in the market? How are you seeing the structuring of consideration and use of insurance?
I see a lot of reps and warranty insurance deals. I've talked very often about using, I'll call it specific issue tax insurance, but I actually have never pulled the trigger on it. But Adam, you said you actually did recently, so I want to hear about that, because I hear it's becoming more and more popular. I just haven't had any experience with it personally.
Yeah, I think it's definitely becoming more common in the market. A lot of the big underwriters or insurance companies have built, bespoke tax insurance. And for anyone that's not familiar, rep and warranty is basically overall reps and warranties insurance for a transaction that would cover generally tax reps and warranties. Whereas the type of insurance we're talking about is basically going out and getting a specific tax position insured. And I think it's being driven by, again, seller's market. People want walk-away deals. They don't want to deal with indemnities. They don't want to deal with escrow. So where there is a hairy tax issue that is not just black and white, right, or, because it would be hairy, it'd be black and white, just wrong. If it's in the gray area, people are looking for ways to facilitate closing a transaction without having to deal with indemnities and escrows and tying people up for multiple years. And I think that's where tax insurance in the M&A context is coming. It's being used more broadly for companies to just, mitigate tax risk generally, but it's being used where, especially where you can get to maybe a decent level of authority on a position, at least substantial authority, or more likely than not, by a reputable firm. There's underwriters that will go in and diligence those issues and then write a specific tax policy. And that allows the seller to basically say, we don't agree with you, buyer, on the level of risk related to this. We don't want to indemnify you, but we will go out and tax insurance, or you go out and get your own tax insurance, and that'll allow us to close the deal more efficiently. So it's definitely, like you said, it's talked about a lot, not being used all the time, but I mean, we're actually working on a number of them currently right now.
And sorry, with our last minutes, just to run through the challenges, and Angela, I know you have great experience in this, so I'm going to look to you for your insights. Obviously, Adam had previously talked about the valuation monetization of attributes being a challenge, but deferred or unbilled amounts, we look at deferred revenue, unbilled revenue, as well as deferred payroll taxes as a liability. What insights can you give our audience as far as what you're seeing and the challenges that the market has?
Yeah, we're definitely still seeing those go through as a liability. A lot of deals, as I know folks in the audience are aware, see, I'll call them current taxes, run through either, run through debt or run through the purchase price as a separate line item as a deduct to the purchase price, with limited survival in sort of these very seller friendly style deals. And one separate line item will often be the deferred payroll taxes. Now, every once in a while, you'll see a seller push back and say that they want the benefit of the deduction in the future for those deferred payroll taxes. But the issue is trying to figure out what the actual benefit would be in the future. So folks have I haven't had a buyer really accept that yet, but I know that the requests have been made and are being made. So that's kind of an interesting development these days. Yep. That's kind of what we're seeing. I don't know if any, I know we have to end, so kind of a slightly more nerdy note to end on, but hopefully folks are finding it interesting.
Yeah, no, it's great. And the insights that both you and Adam were able to share were very insightful. Again, if you want any additional information, you want to talk about what we're seeing in the market, or you want to discuss tax reform, our bios are attached in the back of the deck, as well as, feel free to reach out to us. It's very challenging in this time. Obviously, with tax reform, you're really not sure what's going to come up, and so you're planning for the uncertainty. And while I'm waiting for Kevin to join us on camera so you could switch over to his Answer Connect presentation, I want to sort of note one of the questions we got was, well, is this a matter of politics just dragging their feet? And just note, that the history of people of tax reform not occurring on a fast basis, and you just say, okay, well, this is in part status quo, and in part, the Democrats didn't want to wait until the end of the year. They were looking to get it done months ago. And so there's been hiccups. And so this is just the route we are. And obviously we'll keep you posted on what's happening in the market as well as what's happening in tax reform. But with that, Kevin, show me how I can use Answer Connect to figure everything out and what I should be looking at.
Absolutely, and it's probably easy as all the tax reform you've been talking about for the past little bit here. I just want to make sure, is Answer Connect showing up on screen?
Yep, you're good.
Yes, it is.
Excellent, excellent. So yeah, we just have a couple of minutes here before we've hit our hour time limit. So what I want to start out by saying is if you're interested in taking a deeper look into CCH Answer Connect and how it can assist you with your tax research needs, especially as we manage through these significant changes that are coming in the very near future, would love to set up some time with you and your local representative to do so. I think what I'm going to start out first here is really to just take a look at how we work very diligently to create an interface between Google and a tax research platform. What we've now done, because we know a great deal of research is still being done in Google, there's a great deal of outstanding information available in Google, but with this tax legislation changes that are coming, we now become exposed to potential risk in terms of the documents that we're using on the web. Are they still pertinent and accurate tax law? Can I rely on them, or do I need to verify that whatever's been said in these documents is actually still viable? So what you can see on the screen here is I've actually run a really quick search on business interest expense under 163J. We've now integrated into these search results the ability to link into CCH Answer Connect, tax research platform that we launched about 4 years ago, so you can get directly into that content. But what I want to focus on even further here is the ability to interface a trusted tax research platform into any document you may come across on the web. In this case, I'm actually going to go into an article written by the Journal of Accountancy. Got a couple of tabs opened up here, and I'm reading this information. It's talking about some of the things that's related to the tax law changes that we had, 4 years ago in 2017. We know that there's potential changes coming with this act this month, hopefully. So now I need to be able to verify the accuracy of this information. What I now have the ability to do is highlight anything within a document on the web and simply right-click with my mouse. And I now have the ability to run a keyword search directly within CCH Answer Connect. So what does this mean to you as a researcher? I can now go directly into that document on the web, into CCH Answer Connect. I'm going to open up my code section 163, which will take me directly into subsection J, since that's what I've asked for. And I now have visibility to all current tax law. So I have my complete code section, regulations, explanations. What we've tried to do here is actually compile all relative content related to a given code section or topic into what we've entitled our 360 view. So as opposed to the researcher having to go from the code section out to different regulation database, we've put all of this information here. You're able to simply walk from left to right in a fundamental research workflow, if you will, to receive all of that information. You're actually able to go into our explanations. What are the changes? What do they look like? What do you need to be aware of? We also bring in our forms and instructions. We've brought in our tools. For example, once you've finished your research project, you need to actually communicate your findings, whether it's via a client letter, a decision tool, a worksheet, any kind of that information, election statement. All of that information is brought to you here as well without you having to go find that as the researcher. We've also then brought in our federal state comparison. So now once you finish the federal components, you have the ability to go into the state at which your client or your company is housed in and find out, has that state adopted? Have they modified? Has there been a complete decoupling of the federal provision? How do you manage that process now at the state level? So again, bringing all of that information to you all in one location, so you're not having to jump around within the system to find all of the content related to 163J. I'm going to click back on my home tab, and I wanted to also deal with, Kevin had brought up the issue of cryptocurrency. And as I start the search, you'll start to notice some of the fundamental concepts that we've brought forward within CCH Answer Connect. We now are starting to bring in, just as you start to type, using a modified AI to bring you content. How is Bitcoin and other currency taxed? What are some of the quick answers that we have out here for you? We want to link you directly into the topic pages. I'm going to talk about that in about 30 seconds and how we presented that content for you. Or do you just want to take some of the suggested searches that are out there from us monitoring and watching and building search mechanisms out there for you? We're going to run that search on cryptocurrency. See how slow my internet connection is today. There we go. And what we've now brought for you is your search results. We saw the couple of topic pages on the federal and state cryptocurrency. Trying to get back there. I now have both of those available. So if I want to go back into the cryptocurrency topic page, this is a presentation that's going to walk you through the explanation of what this topic is all about. What is cryptocurrency? Are there general rules? Cryptocurrencies, FBAR and FATCA. We can scroll through all of this information. We also then bring to your attention additional recommended topics that you may need to take a look at. The editors have also brought in code sections that may be applicable to the situation you're dealing in. You can simply click on the code section that was applicable to your research and go back into that 360 view that we just came from. Are there client letters out here that you need to be made aware of so that you can, again, communicate that information? Again, just a compiling of information to give you speed to answer within CCH Answer Connect. I do want to go back to my search results and highlight one other very significant piece as we come upon this legislation is our client impact events. This is where our editorial team are taking a lot of the information that's going to be coming out of these bills and turning it into actionable items that you can use. In this case, the cryptocurrency, we know there was some changes late in the year, this year that modified and gave better clarity in terms of how the IRS is handling this type of transaction. So we've put all of this information together. What are the new developments? The client application, all of that information is here for you as well. Specific time of clients that would be impacted by this. We've talked about the recommended topics from previous pages. Again, we've still got access to all of the legislative information that you could have. Again, just a compiling of this. And again, as we see this legislation change, this is a key component that will allow you to keep current and actually go through the very specific areas of the law change and how it impacts either your clients or how it impacts the corporation for which you're doing business with. So with that, Sarah, I'm going to turn it back over to you for our final polling question. And again, if you're interested in learning more, we would love the opportunity to speak with you.
Great, thank you. Ian, are you going to launch the question? All right, there we go. So I just want to take a minute and I once again apologize for starting late and running late today. You know, technology issues, gotta love them. And I also wanted to remind you that we do have, you can earn CPE with this webinar. And if you did answer at least three of our polling questions, you will be receiving an email with instructions on how to access your certificate within the next 3 to 5 business days. I want to thank all of our presenters. Great discussion today for joining us, and everyone have a great afternoon. Thank you.